Hello, this is Brian Rezny, president of Rezny Wealth Management. Of course, today is question and answer time. We continue to get a lot of questions from not only our TV and our radio listeners, but of course we do get occasional questions from our clients. And we try to pick one or two of those each week and throw those out at you and give you a good answer. One of the questions that has repeatedly come into our office from all sources is really about the bond market and really investors' lack of understanding about bonds. As most investors realize, we are not a buy and hold investment firm. We're not asset allocators. We don't believe in blindly just owning all asset categories and just hanging on to those through thick and thin. The bond market is a great example. And the bond market, generally speaking, works very much like a teeter-totter. When rates go up, bond values go down. And of course, when rates go down, bond values go up. Well, we're kind of at that bottom end of the curve of interest rates, and we're starting to see interest rates start to rise in the U.S. The reason? Simple. The economy is slowly doing better. Ben Bernanke and the Federal Reserve will cut back their bond buying purchases, and that will raise not only the short but also the long-term interest rates over time. And I'm not talking Jimmy Carter Day rates, but I'm talking slowly, maybe 0.5% over the next 3 to 5 years or more. So let me give you an example. The longer you are out at the end of that teeter-totter, the more volatility you get with your fixed income portfolio or your bonds or income-oriented investments. Remember, interest rates rising and falling do not only impact bonds, but they will also impact things like publicly traded REITs, utility stocks, preferreds, things of that nature. So again, the farther you're at the ends of the teeter-totter, the more movement you get. General rule of thumb, every 1% increase in interest rates you see will cause a 10-year bond on average maturity to drop about 10%. So again, a 1% rise in interest rates will cause bonds to drop about 10% on an average 10-year maturity. The shorter the duration, the less downward draft you have with the principal value. The longer the duration, the bigger drop you have in the value of those bonds. Now this is important, and this is one of the things that I've talked about repeatedly over the last year on my radio and TV show, is as an investor, you want to be ultimate short-term maturity in any of your fixed income. Currently at Rezny Wealth Management, we primarily only own floating rate securities. These would be the shortest duration of all fixed income oriented investments, because what we're trying to do is get total return, interest, and not lose principal along the way. If you are in a bond portfolio or you're in other alternative fixed income and rates move up, and let's just assume that fixed income portfolio drops 10%, but you're making 5% interest, you've got a total return gain and loss plus dividend of a -5. That's really important, because if we continue to see an improving economy around the world and rates slowly move up, fixed income investors who are on the wrong side of the duration or the income-oriented investments they own could lose potentially a lot of total return, which is a big negative for your retirement.